What do most people do? Most people are not going to reduce their expenses. They cannot or they will not get a raise, and they cannot or they will not find alternative income producing activities. The only thing left for these folks is to lower their goals and dreams. Revise your plan. And unfortunately, that's what a lot of folks do, is ultimately revise their goals and dreams. Well, I wanted to travel when I got to retirement, but now I'm not going to travel. Now we're not going to do as much as we wanted to do. I thought I'd like to have a new car in 5 years, but it looks like more likely it's going to be maybe 10 years before we can get a new car. Changing your goals and dreams, because you cannot increase the savings that you have for those goals. What should your goals be? Well, again, we talk about any person should probably be trying to save between 10 to 20% of their income. This includes both retirement and personal savings. That's probably a really good place to start. As a basic point, you might say, well, how much can I save at work and receive the maximum amount of free money? So if you could save 3% at work and your company would match 3%, that means you could put away 6% of your income. Maybe now we can say, well, if you could put away 6% there, maybe I need to say, all right, I need to take 4% of my money and I need to continue. I need an additional retirement plan possibly. Once we ultimately get done with this course, you should have an idea of the funds needed for a lot of different plans, least of which will be retirement. I also, quite frankly, believe that you should have a self-rewarding plan. Provide some mechanism within your plan so that when you meet these goals, whatever they might be, that you can reward yourself, right? So if for some reason you could figure out a way to increase the income coming into the house by $500, I wouldn't just increase it by $500 and put all of that towards debt or all of that to savings. Say, family, we've worked hard, we've saved this. Let's go out on a family night out and we're going to spend some money as a family, because you know what, we've been working hard and we need to reward ourselves. That will incentivize those in your family to help think of strategies, to help save money, and to try to move forward. Again, keep this idea of paying yourself first. Only live off of the residual after you've paid for yourself. Automatic savings plans are great. The challenge with these savings plans is that sometimes the money gets kind of locked up, if you will, right? EEE savings plans, savings bonds. These are obviously very safe, but they have very low earnings and they're not very liquid at all. Retirement accounts. Sure, you could get money from there if you want to, but once the money goes in, it's locked up without penalty, and you can't get to it without taking on some penalties. The money market is a great place for short-term savings, things from like 1 to 4 years. Other mutual funds that have income components could also be good for longer time horizons. So there's lots of ways we can incorporate these automatic savings plans. Some have better return opportunities than others. Some are obviously safer than others. Could we use home equity lines of credit? One of the things I'll say now about the home equity line of credit idea is that this is obviously money that's available, but it's obviously tied to your mortgage. And these home equity lines of credit are essentially credit cards. So you have to really watch. We'll talk a little bit about credit cards a little bit later, but I mean, a credit card, the way interest is charged, you could be paying on these home equity lines of credit for a very long period of time. They have minimum payments that are less than what you should be paying on. So if you wanted to pay this off in 3 years, it would be nice to know what that payment would be. They don't tell you what that is, so you may want to do that. Now, actual credit cards, they do that now. They do give you a piece, and it's unfortunate that equity lines of credit don't do that. Emergency funds could certainly come from cash value life insurance policy, we talked about how terrible that is. Company savings plans, sometimes you can save within the company. Money that's in an IRA could certainly be used. Of course, there's penalty. Again, what I say here is, the text lists these as potential sources for emergency money, but they are by far the worst choices you can make. I mean, they have challenges that cross the spectrum here of liquidity issues, return issues, risks, taxes, interest, penalties. These emergency funding strategies are just not the best choices. If you're looking for savings tools, we really need to keep in mind three things. What's the safety of the tool? What's the liquidity of the tool? And what return do you ultimately get? Safety, we certainly understand. Is the principal that you invest, is it safe? Is it likely that the value of this thing could decrease due to changes in the economy, if you will? For the most part, the instruments that are in these short-term types of investments are very safe. You typically don't have to worry about them losing value. Liquidity is another issue. Can you get to the money quickly and without losing much value? One of the things I tell you is certificates of deposits. I mean, one of the things they tell you is, if you withdraw this prior to maturity, that there is a huge penalty for early withdrawal. There is a penalty for early withdrawal. I mean, typically it's like half of the interest within a year, but in general, if you're only making, right now a 5-year CD, you may be able to find one that pays 2%, but probably not much more than that. I mean, losing 1% on an investment isn't all that great if you could move that money from 1% to a mutual fund that could earn a little bit more. So obviously, the return that you earn is going to be less because these have a lot of safety. They're not very risky instruments. So they don't have real high rates of return. So really what we're worried about here is the safety and liquidity piece. I, quite frankly, believe in money market mutual funds. And I kind of put the two things here. This money market thing up here should have to do with banks. I'm sorry about that. There was an error when I was inputting that. I mean, banks have money market instruments that are really not the same as mutual fund instruments. The money markets for mutual funds invest in primarily treasury bills, commercial deposit things. Again, I don't know why these things are duplicated in here. Let me just get rid of this because that just doesn't make any sense. So we'll just put in here this mutual fund. But the mutual funds that are in banks are not the same as the money market mutual funds out in the public. So they're slightly different. They have lower returns, but they have different assets they invest in. Your book gives you this little table. The one thing that they have left out of here are the money market mutual funds. And I've kind of added here, again, my opinion of these things. And again, across the board with respect to safety, liquidity, simplicity, services, all of these are A rating as far as I'm concerned with money markets. The rate of return, it's not a terrible rate of return, but it's not great either. So it's probably a B. It's in that B range. Minimum, here they say, a mutual savings bank, savings and loans. They have them here classified as an A. That is not true. The rates of return are not that good, relative speaking. Compared to these, they probably have a higher return, but not with respect to certain other kinds of investments that are available. Do you have minimum requirements? Typically, most of these don't have any, but some do have some. Treasury bonds and municipal bonds, you need to have a fair amount of money to purchase those. And then finally, the last thing is they're a tax advantage. Of course, with money market mutual funds, you're investing in things. Because there's treasury bills in there, you won't pay state taxes, but you will pay federal taxes. So there are some tax advantages to money market mutual funds. In the end here, we got to ask just a few more questions. Number one is what's the difference between debt and credit? Credit is the tool that's used. Credit is the picture of what your ability is, right? So debt and credit, as it says here, are two sides of the same coin. Debt's the tool, credit is the picture, if you will. So what are the sources of credit? Where can you go to get debt, right? Obviously, we go to all these places. Everybody's familiar with them. Frequently we go to credit unions and banks are the most frequent places we go. Certainly people often borrow money from their life insurance policies. Again, time and time again we say how that's just not a really good idea. What does your credit history look at? So what we want to talk about briefly here is, what is your ability to borrow money? I mean, banks typically look at three things. They look at your character. That is, they reflect on honesty, right? They look at capacity, your ability to pay. Capital. Do you have collateral that you could use? And those three things together, along with a lot of other information, basically address the question of what should your credit rating be, right? So we have, again, everybody is probably familiar, we have things called a FICO score. It is a measurement of your credit history, your ability to pay. And of course, lending institutions will base the interest rate that you pay on the level of your FICO score, right? Now you can request a report once a year. Now what you also have to watch, though, a lot of companies say that you have to give them a credit score, right? Or excuse me, you have to give them a credit card. So you're essentially signing up for a service. So you don't want to sign up for a service, you just want your number. Unfortunately, this isn't the easiest thing to get. I mean, you would think that since credit companies are providing the information, they would pay the cost of us to be able to get our credit scores whenever we want. There are some challenges with that, but you are allowed to get it at least once a year from the credit bureaus themselves. What are those standards? Again, this is just a series of questions that are basically talk about your employment. When is it favorable? When is it unfavorable? And again, these numbers, some of them not necessarily numbers, some of them are qualitative kinds of questions, are converted into numbers, and in the end, you end up with a loan or a standard or converted to a FICO score, if you will. That is a measurement of your overall return. And we'll talk about some of this stuff once we actually get into class. What basic types of credit? There is non-installment credit and there's installment credit. I mean, essentially, non-installment credit is a single payment credit. Maybe it's for charge accounts. I mean, think of this more like utility bills. You pay the bill every month. Installment credit, though, is where you're paying off these loans over time, right? A variation of that, obviously, is possibly a credit plan where you can write checks against some form of a credit limit, if you will. So, again, there's a variety of different plans that we ultimately can utilize to pay bills. What kinds of sales credit are there? Well, obviously, we have 30-day types of plan. There are revolving accounts. Again, I don't think we need to get into the definitions of what all these are, but there are a variety of ways to get money, to borrow funds. There are also then obviously a variety of ways of charging interest. The effective interest, the thing that you're most interested in, is the true interest that's calculated after all the charges are taken into account for this particular credit account, right? The interest obviously represents the price you pay to buy. Quite frankly, this is not the most important number. It's interest itself is not the most important thing. It's the dollar amount of interest that you pay. So it depends on how much you borrowed, the length of time, the actual calculation of interest. If you think about a credit card, in general, a credit card, there are about 6 or 7 different ways that a credit card company can calculate interest on a credit card. Well, do you know which way your insurance company, your credit card company uses? I would wager to say that you don't, because It's not something that's advertised. It's in the gray print, if you will, that fine print. So we need to understand how they actually calculate interest. So finally, let's talk about this burden of debt, right? Every family should limit the amount of debt that they have. Again, we talked about this a little bit earlier. You should have a business policy, right? We want to keep debt at a certain level, right? When business meets their amount of debt that they don't spend any more money, right? Again, this is not real practical for everybody, especially young people, since they have things like student loans, right? But maybe we should keep our debt level so that personal debt divided by the equity ratio is below 1. So that is that we always have more ownership than we owe debt. Again, there's challenges with that, but again, we need to understand, if we can understand how we're paying for things, how interest is calculated, we can manage this process of debt a little bit better. Again, here's a quick calculation, to say, what does your current debt limit look like? Again, if you put in your payments, your gross income, right? Take your total income, calculate that out, find out what your debt to income ratio is. If it's less than 35%, you're excellent. If it's over 50%, you're in a danger zone and you need some help. You need to figure out how to get this debt down. And the last thing I want to just briefly talk about is bankruptcy. Again, bankruptcy is no longer taboo, right? I mean, historically, it was nobody ever talked about bankruptcy. But it seems that over the last 10, 15 years, with some changes to the bankruptcy law, people just become very lackadaisical about this concept of bankruptcy. It's just not bad. They just know if they get into trouble, they'll declare bankruptcy and somebody will wipe their stuff away. Now, is it true that for the next 4, 5, 6 years they won't be able to borrow any money? Yes, but they don't care. So it just doesn't matter to them. So what we want to do is think about, the importance of meeting our obligations, right? How can you avoid bankruptcy, right? Again, you could borrow from your 401k if you had to. Maybe you can modify your lifestyle so you can increase payments. You can go to credit counseling, right? And there's even certain parts of the bankruptcy code allow for something called a wage earner plan, right? So maybe what this will do is you'll show your revenues and debts, and you can then create a plan that the court, the creditor, you, and the debtor, right? Or the debtor and creditor can live with. So the debtor, you don't give up any assets. You don't declare bankruptcy, but you create a plan so that ultimately you can pay off the debts that you owe. So again, that's a brief picture of cash management. Certainly we'll talk about some of these concepts when we get to class.